Let's take the discussion on markets forward with the Pankaj Tibrewal of Kotak KMC also joining us now. Pankaj, morning. Thanks for making it finally to the show. We were looking forward, given that there is so much of talk around mid-caps. We are witnessing very specific flows into mid-caps, even by your FII brethren as well. And there is outperformance there. So are you finding it challenging to look for or identify mid-cap ideas which are still not very heavily or highly priced and are attractive in your risk-reward gauge?
Hi, Ajay. I think being a practitioner in this space for more than 15 years now, we have seen cycles playing out in this space. And in the near term, our view is that one needs to be a little cautious on this mid and small cap space after the run-up which we have seen. And there are 3 or 4 data points which we want to share with you, which is giving us that some sense of cautiousness in the near term. Though we all are believers that this is a wealth creating space, and if you are patient enough, disciplined enough over a 5-year, 10-year cycle, this space tends to be generally very good from an investor return perspective. But in the near term, there are some dark clouds which we need to be careful about. The first point, if you look at from a earnings yield perspective, which is nothing but 1 by PE, today the earnings yield of large, mid, small is virtually the same. So large caps are trading at an earnings yield of 4.5, mid caps are trading at an earnings yield of 4.8, and small caps actually are trading at an earnings yield of 4.2. And mind you, these are all profitable companies, which we are talking about, removing the loss-making companies. And when you look at this matrix, it doesn't make sense to take extra risk on a mid and small cap when large caps is offering you the same earnings yield. That's the first point. The second point is when you look at the mid and small cap cohort as a percentage of total market cap, it's now at historic extremes and at about 30-31%. And large caps have come below 70%. So clearly this points that the mid and small cap as a cohort has done extremely well. And a percentage of market cap, it is at historic extremes. So one needs to be careful about that. The third point is that the earnings yield minus bond yields in the mid cap and small cap space is almost reaching to that 2017-2018 highs. And it's about 4.5% negative earnings minus bond yield. So clearly, this is again one fundamental indicator which is pointing towards that. And last but not the least, if you look at liquidity has played a major role in terms of mid and small cap performance. So we have seen very sharp inflows into the mid and small cap funds over the last 6-8 months. In the last 3 months, 1.9 million folios have been opened in the small cap funds. And especially in the month of July, almost 0.8 million folios, new folios have been opened. So this shows that liquidity has been extremely strong in this space, whereas the free float market cap of mid and small caps have not increased to that extent as much as the shareholding which we see by FIs and domestics. So too much money chasing too little assets. So I think one needs to be little careful because cycles have become shorter and sharper, and one needs to be cognizant about that. Though from a 3, 5, 10-year perspective, if you want to express your strong top-down India view, this space you cannot ignore. But always we have seen that this space tends to be sharper while times of correction as well. I still remember 2020 March, the 3-year, 5-year and 10-year, the SIP returns in this space had become very, very inferior and people were worried. And last 3 years did magic and the entire returns are looking great. My only advice to investors will be that if you are coming in this space, come with at least 5-year view and be ready to see some volatility. Volatility in India has been at extremely low levels at about 10.2, one of the lowest we have seen over last many, many years. And volatility is like a spring. If you compress this too much, it comes up very fast as well. The reason we come to know on the hindsight. So a bit of cautious in the mid and small cap space as a moment. It will be a stock pickers market. We need to be extremely careful that we don't get carried away by momentum and invest in companies where we are not, convinced about the management quality or balance sheet and cash flows. Because mistakes are generally made in good times, and then probably it hurts you over a period of time when you realize that. So just don't go down the quality curve. Uh, a very strong anchoring to quality bias right now, and making sure you make less mistakes in this market.
That's always the aim, isn't it, Pankaj? But how is it that you ensure that right now, Pankaj? Because quality comes with a price, and we've seen that across market cap categories, the good names are expensive. So do you buy more of the same if the market does give you a decline, mid or large caps?
Uh, there are pockets of opportunity. For example, if you remember on your channel a few months back, we said pharma could be the dark horse for FY24. And clearly in the first quarter earnings, we saw pharma as a universe delivered about 24% earnings growth, almost after 6 quarters of decline in earnings. So clearly pharma saw a very sharp up move over the last couple of months. And that was one pocket of opportunity and still remains one pocket of opportunity because valuations are reasonable out there in that sector. And we believe that over the next few quarters, earnings should be quite strong, led by the drug shortages in US and steady growth in the domestic market. BFSI also continues to be reasonable on valuation. If you look at the large private sector bank, they are not excessively expensive. And there are pockets of opportunity in the BFSI space, whether it be insurance, whether it be banking, whether it be NBFCs. Industrial manufacturing continues to be a strong theme. And though in the near term, valuations have run up a bit, but if you take a 3-5 year view, I think there are many companies and subsectors within that industrial manufacturing sector which offers pockets of opportunity. IT is a tricky space. We believe that there's one more quarter of earnings downgrade cycle before IT sector kinds of bottom out. And if one is looking to invest in IT sector, it has to be from a 2025 FY25 perspective on earnings. By and large, that's our preferences. And auto anchs continues to be strong. Even in this quarter, you saw that auto anchs continue to have a very strong performance. And I think that's where our preference lies at the moment.
Okay, that's the overall sectoral theme. Pankaj, give us a view as well as to what your sense is when it comes to the liquidity situation. Given that there was a short spate of FII selling, now the buying seems to have emerged right back. Just going by the overall macro setup as well, what is it that you're anticipating on the liquidity front?
So liquidity, you have to divide it into two parts. One is the domestic liquidity, and I think there is a structural change in that. We saw it last year that the domestic, or last 2 years, in fact, in CY22 and CY21, when FI selling continued, domestics came at rescue. And I think that, buffer is now about 320 to 350,000 crores, annually speaking, which is including the SIP book at 15,000 crores per month. Then you have the insurance companies, then you have the alternates, and then you have the EPO for money coming in. So domestically, I think we have created that strong buffer in terms of our dependence on FIs. Coming to FIs, I think our sense is that over the last 6-8 months, the interest of FIs for India has gone up materially high. We are every day meeting FIs where we haven't heard the names also, and they are doing homework for India. And largely that is to come from that incrementally they don't want to increase their exposure to China. And among all the major economies, and especially emerging market large economies, India will be the fastest growing economy, relatively speaking. So I think if you take a 3-5 year view, we are quite positive that the FI inflow into the markets will continue to be very strong. That's the reason that you are not seeing or anybody saying that markets will see a very sharp correction. At best, markets could see a consolidation phase where you could see maybe 8-10 months of consolidation, time correction, and then probably valuations and earnings again catches up together. But from a flow perspective, we are not so negative. Domestic is more structural in nature in our view. Equity cult is there. And on the FI side also, we believe the interest is extremely high. If we don't do any self-go, if we don't make any policy mistakes, I think this interest is just going to increase from the FI side.
Interesting observations. There are FIs out there who you haven't even heard names of. That's interesting, Pankaj. You've been around for so long. But I want to understand from you, how are you approaching some specific areas? Like, yesterday the commentary from REC was, they want to turn net NPA zero in the next 2-3 years. NTPC has, surged to almost a 14-15 year high. There is huge interest in QIP offerings or block offerings from some of these renewable guys, Suznol and Inoxes of the world. Which part of the power value chain are you finding most value in right now? Because many have run up, some haven't in the same proportion. Where should the new investor, look for value in this entire power value chain?
I think if you look at the entire power sector, I think it's a very strong thesis for the next 3-4 years. And let's look at some of the data points. The power demand continues to rise at a very scorching pace. And clearly we have seen that peak demand numbers being, broken out. And the latest data again points towards that. So demand continues to be extremely strong. Now look at the supply side. The additions are mainly happening on renewable side, and incrementally very few thermal plants are coming on stream. And renewables come with its own challenges. We don't have a battery storage environment or ecosystem today. We don't have a transmission which is more agile towards renewable. So there are those challenges, and that's clearly reflected in the daily price of power. If you look at in the afternoon today, if you look at the IEX numbers, the power cost is at 2.5 rupees. But after 4:35 p.m., when there is peak demand in India, the power cost has started rising to 10 rupees. So that clearly shows that the timing is a mismatch right now. And clearly we don't have storage. We don't have that agility on the transmission side. And we believe that this would create problems from a power sector perspective. And merchant power will become a very important tool in the hands of generators. So the entire power value chain should do well, whether it be transmission guys, whether it be the generation guys, whether it be the guys who are doing the EPC projects. And we incrementally are quite positive on this space, just considering the demand and supply. India cannot afford to have no thermal power generation. Incrementally, I think we will need to also plan the thermal power generation as you move ahead.
Right. Pankaj, interestingly, you were talking about opportunities within pharma and IT as well. Now, many think or rather consider IT still as an untouchable area, and, many question marks on whether or not this is going to be a slow grind story, at least for the service providers, and whether the ones like a Persistent or a Map My India, special situation, quasi-AI plays are the ones which are going to deliver better from here onwards. Wanted to understand your thoughts on where within IT should one be hunting, because I guess IT can't be an across-the-board play now. You've got to be very selective.
I have heard this argument time and again that Indian IT services are a write-off. I still remember 2008-9 when there was global financial crisis, banks were under pressure, and everybody said that Indian IT services, which depend on US banking to a larger extent, probably will have a tough time. Many will go bankrupt, and probably the best of the IT sector phase is behind us. From there, we have moved a long way, and today IT services exports are about $170-180 billion. Don't forget that whenever there are cost pressures, when there are cost takeouts, people would like to outsource, and Indian IT services clearly benefit out of it. And cloud adoption, which is a slightly medium to longer term theme, globally, it's still at 30%. There's a long way to go on the cloud adoption side. And Indian IT services are playing a very important role in the implementation of the cloud servicing. Having said that, I think what I have said that in the near term, there seems to be pressure on earnings led by delay in some projects by the large MNCs. Also, the fact that you have seen discretionary spend cuts. So people are spending where it is needed the most rather than spending on the discretionary projects. So that leading to some slowdown in the Indian IT services. But I think it's more transitory in nature, maybe 2 quarters or more of earnings downgrade cycle. But I think FY25 starts to look promising again. You have seen the deal win announcement by large IT companies, multi-year billion-dollar deals. Playbook is there. And I think FY25, when I look at the order inflow today, I think that gives us a confidence that the earnings growth or the revenue growth for the sector could be much better than FY24. So over the next 6 months, I think it will be the time to selectively start picking up stocks in the sector and probably move more towards equal weight at the sector level rather than underweight.
All right, Pankaj, good to have you on board. Thanks very much for sharing with us your rationale on the market. So yes, it continues to remain a bit cautious when it comes to the mid and the small caps, and talking about how, yes, this is a stock picker's market.